Hi, I'm Sam Slater from Chelsea, and today I'm joined by Carl Stick, manager of Rathbone Income Fund, which is on the Chelsea course selection. Hi Carl.
Good morning.
You've been running this fund for 20 years come January. That's a long time in the same job. What do you like so much about running UK equities?
It is a long time. I don't know, I think, I stumbled into this, it wasn't something I had necessarily planned to do. I actually started the role, it worked, I enjoyed doing it, I love the variety, every day you're doing something different, you're seeing lots of companies with generalists, so there's a massive variety. So certainly to begin with, there was that excitement. That was what really drew me to it. I loved looking at companies. And actually when you get it right, it's a good feeling. I think as time has gone on, it's changed. I look after a bigger team now and we run other mandates as well. So the job has changed, the challenges have changed. You've got 20 years of experience, so you view it in a different way. So I still very much enjoy it, but my job now is different to what it was 20 years ago, which I think is only right. I mean, I'm 20 years older and you have that experience. So I still enjoy it, it's just different, but the variety is still there. It's still a different thing every day.
And what have been the highs and lows over those 2 decades, and perhaps your best and worst stock picks maybe?
I think over 20 years you see different cycles. I mean, when I came into this, we were seeing the shift away from the TMT boom. March 2000, the market started to drift back, and we benefited from that change. We have a lovely run up to about 2007, global financial crisis, massive hit. And that affected us. We ended up making people redundant. You realise you're not just running a fund, there's a business around you and the ramifications of that cycle. Markets move ahead again. We've had this strange period in the last 10 years where markets have kept on going up, and you've always had this nagging doubt that things aren't quite as good as they might be. And the last 2 years, 3 years, we've had Trump being elected in the US, we've had Brexit, a lot more uncertainty, markets have continued to edge higher, and I wonder now whether we're at a point of change. So, highs and lows in lots of different ways. Best and worst stocks. The best stock, I think, is easy. It's an interesting story. One business that we've owned for about 17 years is a pharmaceutical company called Dechra Pharmaceuticals, which when we bought it was not an obvious pharmaceutical company for the fund to have. We'd never really owned many pharmaceuticals 20 years ago, but we bought it end of 2002. They had a profits warning. The shares halved, which was a lesson thinking, what have we done? But then we had the courage to actually buy more on that warning. And the shares ever since have turned into a bit of a darling. They're a growth business now. The company has done extraordinarily well. It's changed its spots. It is more of a growth business. It's involved in veterinary pharmaceuticals. I think the shares are close to £30 now. So that's 60 times the 50p that we might have paid back in 2003. And one final point, the chief executive at Ian Page, who's been running it all that time, he has changed a small business to one that is very, very large now and massively successful. So he's changed as the business has changed. It's a terrific story. Worst stocks, far too many to mention, Sam, far too many. No, the thing is though, I think, there are always going to be things that go wrong and they always hurt and you always remember them. I think the biggest lesson was actually from a sector where we performed very well. We bought car retailers when they were really cheap at the start of the 2000s. And there was a point in time when one of our holdings, called European Motor Holdings, was bid for, and the management came in and said, you know what, this is far too expensive, we've got to accept the bid. Which was terrific for us, but what we didn't do was sell our remaining exposure to that sector. Somebody said to us, the shares are too expensive, the sector's too expensive, and we ignored that advice. And over the next couple of years, 2 or 3 holdings that we had in that industry really hurt us when the global financial crisis hit.
And over the past 20 years, you've had incredible success raising the dividend on the fund. I think in 19 of the past 20 years, it's gone up. What's been the key to that success? And could you tell us what happened in that 1 year and whether that might happen again?
Well, I think the key to the success is my original starting point on the private client side. And you're talking to clients and you realise how important income was. So when I started running the fund, growing that dividend every year was key. It's an obvious thing to do. We've still got a client who thanks me every year for the rise in the income. It's a pay rise every year. So we focused on that. It was a real focal point, and it's remained the focal point over the 20 years. It's a simple message. Give your clients a pay rise every year. The 1 year we didn't, it was around the time of the global financial crisis. We have learned lessons from then, but we had big banks growing their dividend at massive amounts. I think Royal Bank of Scotland was growing its dividend about 25% a year for 2 years. That terrific growth, we should have realised it wasn't going to last. So when they cut their dividends, when we had that big shock, we had to reduce our distribution. Not by as much as the market, but we still had to reduce it and rebase it.
And contrary to how people might think you might invest, you recently topped up a position in a company called AB InBev, which had actually cut its dividend. Why would you do that?
Well, AB InBev is a global beer business. It's a terrific business. We only had a small holding in it. People have been very worried about the debt on its balance sheet. After when it decided to buy SAB Miller, it had geared up to do that. Now, the management were quite relaxed about that, but investors weren't. We had this small holding. Management decided, you know what, we're not being rewarded by paying out a high dividend. We will reduce the dividend and work more at paying down the debt. And the shares recovered on the back of that. Our view was that we were actually welcoming that dividend cut. The moment they did that, the business risk is reduced, the financial risk is reduced. We're actually going to get better dividend growth from that lower point. So we actually bought on the dividend cut because we felt the business and the financial risk had been lessened by the management actions.
And coming back to the present day, we've got, as you say, President Trump. We still have Brexit hanging over our heads. There's talk now of a recession in the UK, perhaps in other countries as well. How does this impact how you're investing in the fund, how you're positioning it at the moment?
Well, we've always said, look, we're never trying to predict the future. We've got no idea, and anybody who says they can, obviously, it's madness. So what we do is we try and balance risk across the portfolio. It's never a case of let's put all of our chips on black and just hope we're right. So we have a balance of risk, very much focused on the prices that we're paying for stocks. So we do have exposure to the UK because we think it's cheap, but there's a massive risk there around Brexit. And it's not so much October the 31st, irrespective of that date, is that we're only at the start of the road. You know, there's a lot more to go. But how much of that is priced in, these stocks may be cheap. Globally, we've got a lot of businesses that have done really well and the share price has reacted accordingly. But that's in the price. You know, these are expensive stocks. So, you know, to what extent do we maintain our positions there? We've been very consistent in the last couple of years of emphasising trying to balance risk. We do not know what's going to happen, but we're always just trying to sort of temper our exposure in certain areas so we're not beholden to one outcome or another. And what is interesting, bringing things right up to date, is when you look at the UK and think, oh, I don't want to go there, Brexit, our economy, and all the bad things that we're worrying about, there is value there, and we are starting to see M&A activity, as evidenced by the takeout of Green King yesterday. There is value in a lot of these UK stocks. It's how patient you're willing to be and how much business risk you want to take on within the portfolio.
That's great. Thank you very much indeed.
No problem, Sam.
For more information about the Rathbone Income Fund, visit chelseafs.co.uk.